Hey team, accounting fundamentals. The general area, we're still working on adjustments to the trial balance. And specifically, we're starting a series about the special snowflake called depreciation. We know that the accrual accounting, well, that requires adjusting entries, and adjustments happen for all sorts of reasons. And one of those reasons is this new concept called depreciation. We know, of course, that adjusting entries, well, they're journal entries used to reconcile transactions that straddle different accounting periods, 1 month to the next, 1/4 of a year to the next quarter of a year, the end of a 12 consecutive month of financial year to the beginning of the next financial year. Adjusting entries, lots of different reasons, lots of different applications used at different times. We've looked at adjusting entries related to expenses. We've looked already at adjusting entries related to revenues. And finally, it's been waiting patiently, adjusting entries, depreciation. Here is our dive. But what is depreciation? What's the purpose of it? What does it do? Let's take a quick look. So, quick statement. Depreciation, well, it's a reduction in the value of an asset with the passage of time due to wear and tear. So the second line says, if you're an accountant, provision should be made for depreciation of fixed assets. Okay, a couple of things to unpack here. It's a reduction in value of an asset over time. So you buy something, over time it gets used, it's worth less value over time because of wear and tear. It starts to wear out, it starts to break down, it starts to get dented and all sorts. So provision should be made for depreciation of fixed assets. Of assets is a lot of different things. A fixed asset is something that carries a lot of cost with it. A frying pan is an asset, but it's not a fixed asset because it doesn't have a lot of cost associated with it. We're talking about big dollar items when we talk about depreciation. So depreciation, what does it do? It allows for us accountants, the process, bookkeeping, to record the reduction in an asset's value over a period of time. And it allows for allocation of a fixed asset item's expense over a period of time. If we bought an oven for $25,000 in year one, then the expense of that item is going to really throw the financial records off balance that year because there's a big $25,000 expense in that year. And that oven is going to get used over multiple years. And it doesn't seem fair that all the other years that oven is going to get used doesn't have to bear some of the cost of buying that $25,000 oven. What depreciation does is it carries some of that cost forward and expenses some of that significant cost over extended periods of time. Okay, reduction in an asset's value and allocation of a fixed asset item's expense all over a period of time. So, quick example, and I think it makes sense to dive straight in and use some language that you haven't even heard yet to help you get a sense of where we're going. Language in yellow is going to be language related to depreciation. So watch where this goes. So let's say we buy an oven, it costs $28,000. That oven is called a fixed asset. It has a big cost and it's going to be used for a extended period of time. It's expected to last for 15 years. We're going to call that, in depreciation terms, its useful life. At the end of the 15 years, we figure its value will be $250. Like, it's going to be a piece of junk. That oven, all I'll be able to get for it is $250 for the metal that's in the oven. And the language we're going to use related to depreciation is we're going to call that its salvage or residual value. Depreciable cost is another important term. Depreciable cost is the $28,000 original purchase price minus its salvage or residual value, in this case, $28,000 minus $250, its depreciable cost, the cost that we can depreciate, is $27,750. Again, using language that we haven't really unpacked yet, just to help you get a sense of where we're going. That $27,750 depreciable cost divided by the 15 years useful life gives us a dollar value of $1,850 depreciation expense, new term, per year. What's the result of all this? Is each year the business can depreciate the item's cost as an expense for the amount of $1,850. That means The original $28,000 minus the $250 residual value of $27,750 divided by 15 years is $1,850. The $1,850 is dropped into each of the 15 years as an expense so that each year carries its own bit of weight related back to the original purchase price of $28,000 minus the $250 salvage residual value. Each year, the business can update the book value of the item, meaning that each year the oven is going to be shown a different current value, a book value, across each of those 15 years. Again, using terms that we haven't unpacked yet to help you see where we're going. And ultimately, adjusting journal entries are made to reflect this amount into a new term, a new account that's going to go into the chart of accounts called depreciation expense. Lots going on. Let's take a look at some of the language. Now, in the course packet, there's reading that supports all of this, and there's images in the course packet that relate to some of these ideas. This straight line here is going to come into the conversation. This percentage is going to come into the conversation. And the idea of dragging away a junker at the end of its useful life is going to come into the idea. And specifically, there's a whole lot of different ways to work out depreciation. Specifically, the one style, the one approach of depreciation that we're going to use is called the straight line depreciation method. Here's the straight line associated with a straight line depreciation. So to take a look at the terms that I've used, but we haven't looked at or unpacked just yet. Those terms, there's a lot of them. They're all repeated in the course packet. So the reading is going to be really helpful to help support this information. Terms of accumulated depreciation, salvage residual value, book value, useful life, depreciable cost, and the straight line depreciation method. So terms related to depreciation, let's unpack them one by one. Useful life. Follow the red rectangle. Useful life is an estimate of the expected productive life of an asset. Like for how long will it be productive and of use to us? Useful life can be expressed in terms of time, number of years, units of activity, maybe not necessarily related to the oven, but a number of revolutions that something like a piece of machining equipment might use, or the units of output, the volume, the productivity of that item. We're going to use the units of time in the examples that we use. Follow the red rectangle. At its essence, it's important to recognize that the term useful life describes the amount of time it takes for an asset to, in accounting terms, not market value terms. Market value would mean what somebody in the market would pay you for it. Lose 100% of its original value through wear and tear and age. So we're talking about accounting terms. Market value is what somebody in the market would pay you for it. Accounting terms is going to be a figure that we're going to estimate. New term, salvage or residual value. The concept of salvage value or residual value is another term that applies within the context of depreciation. Salvage value or residual value is an estimate of the asset's value at the end of its useful life. That's the image of someone dragging away the junk car at the end of its useful life. So salvage residual value is an estimate of the asset's value at the end of its useful life. Continuing with salvage residual value. Think of salvage or residual value as the amount of money the item could be sold for in the market at the end of its useful life. Like a car with 250,000 miles on it being worth, somebody's going to offer you 750 after you originally purchased it years ago for $5,000. We know that a car loses value over time. One little caveat is we're going to use an accounting estimation rather than what we think somebody would give us. And we're not going to negotiate with people in the market to come up with, give me $1,000 versus $750. But the concept is still applies. Think of somebody dragging away that junker car at the end of its useful life. The estimated salvage value of an asset is subtracted from the original purchase price at the onset, at the very beginning of this whole depreciation process. Depreciation is a process that happens over a period of time. Depreciable cost, another term. So purchase cost minus salvage value or residual value gives us something that's going to be known as the depreciable cost. Depreciable cost is the remaining dollar amount that can be depreciated over an item's predetermined useful life. So the useful life is how long we think it's going to be of value and give productivity to the business. Now, that's predetermined by the IRS, the Internal Revenue Service. They say that different assets, like a vehicle, accountants can use a depreciable useful life of 5 years. So it's predetermined amount of time. Different assets, the IRS determines the useful life. It's predetermined by them. We don't get to make that number up. Book value, another important term in relation to depreciation. Book value is an asset's original cost minus its depreciation. So therefore, book value is in a formula form, it's the asset's original cost minus depreciation. Now, depreciation is going to happen over an extended period of time. So as more depreciation happens, book value is going to change over a period of time. Important point. We're going to see how this works when the time comes for us to start working these numbers into a worksheet. The concept of accumulated depreciation. An account, so we're back to the filing cabinets of accounts. An account called accumulated depreciation is used in a business's chart of accounts to reflect the total depreciated cost of items that are being depreciated. Pause there. A business might have lots of items that they're depreciating. The dollar value of depreciation for each and every one of those items that are being depreciated will all go into this one account bucket, one account drawer called accumulated depreciation. This accumulated depreciation account will be used when making journal entries. Yes, this is going to lead to journal entries that capture depreciation adjustments that are made within the business's bookkeeping process. So accumulated depreciation is a new account in the chart of accounts, a new drawer in the filing cabinet, right? The mental image of the filing cabinets as we understand accounts. Okay, so this idea of journal entries, right? Journal entries are going to be coming our way. And this idea of straight line depreciation, which is one of the many different methods for applying depreciation. The straight line depreciation, it's got a straight arrow, straight line for straight line depreciation. Here's where we start to unpack straight line depreciation. While there are several methods for calculating depreciation, good news is for us, straight line depreciation is considered the simplest. Under the straight line depreciation method, companies expense the same amount of depreciation each year for the asset's useful life. That's that straight arrow that was in that other image. When a company uses an annual straight line rate percentage, it applies the same percentage rate for each year to the depreciable cost of the asset. Under the straight line depreciation method, a company therefore also applies the exact same dollar amount of depreciation across each year of an asset's useful life. Oh my gosh, is there a lot going on here? Absolutely there is. We're going to have to pause, we're going to stop, we're going to slow down, we're going to rewind. There's a lot to unpack, right? You're going to have to work hard at this depreciation unit. This idea of a rate percentage is going to come back into play when we start to use a worksheet application of this. This straight line depreciation, the depreciable costs of an asset will be, here's our percentage, 100% depreciated over the period of the asset's useful life. For an asset with a useful life of 5 years, the annual depreciation rate is calculated by taking 100% divided by 5. We get 5 years useful life. 100% is the end goal. We need to be 100% depreciated by the time we're done. 100% divided by 5 equals 20%, meaning that for each of those 5 years, 20% of the depreciable cost will be depreciated in each of those years. This will all make sense when we get to applying this in a worksheet. 20% percentage, right? We're following through the idea of percentage. So the images that I believe are really powerful here. is depreciation, straight line depreciation. This idea of using a percentage is embedded in depreciation. And the image of somebody taking away a junker car at the end of its useful life, residual value, salvage value, all these pieces relate. And the one method of depreciation that we're going to use is the simplest, lucky for us, this concept of straight line depreciation. We're going to have to watch the video maybe multiple times. We're going to have to dig into the course packet, read these constructs and these concepts multiple times. There's another video coming that's going to help us show the application of depreciation. But for this video, which was a guided tour of the language and the concept of depreciation, objective met. Objective met means end of video.